The FTSE 100 is the Premier League of the UK stock market, a list of the 100 largest companies on the London Stock Exchange, ranked by market value. These are household names, major banks, supermarkets, energy giants, the backbone of the British economy. People invest in these companies for growth, hoping their shares will increase in value over time. It's also about stability. These large, established firms are seen as safer bets than smaller businesses. Many FTSE 100 companies pay dividends, a regular cash payment to shareholders, making them attractive for those seeking income. Dividends can turn your investment into a source of steady cash, not just future growth. Understanding the FTSE 100 is your first step to taking control of your financial future. It's not just for city traders, these companies shape our daily lives. Investing in them lets you share in their success. As we move into 2025, knowing how the FTSE 100 works can help you make smarter decisions with your savings. Let's explore how your money can work harder for you. Let's talk about dividends. A dividend is like interest from a savings account, but it comes from owning shares in a company. The dividend yield shows how much you get back in dividends each year as a percentage of the share price. For example, a 5% yield means £5 back annually for every £100 invested. High-yield stocks offer bigger payouts, sometimes 7% or more, making them appealing for regular income. This is especially attractive for those nearing retirement or wanting steady cash flow. Even if share prices don't rise, dividends keep coming, cushioning your portfolio. You can reinvest dividends for compounding growth or take the cash for expenses. But beware, a very high yield can signal trouble, like a falling share price, or worries about the company's future. Always check why the yield is high before investing. Let's look at Legal & General, a high-yield FTSE 100 company. With roots back to 1836, they're a giant in UK financial services, life insurance, pensions and retirement planning. Their strength is diversity. They manage money for individuals and institutions and invest in UK infrastructure. An ageing population means growing demand for their services. Their investment arm, LGIM, is one of Europe's largest, generating steady fees. Legal & General Capital invests in housing, clean energy, and regeneration, supporting both the economy and their returns. This broad business base makes them a reliable dividend payer. Multiple revenue streams mean resilience, even if one area faces challenges. That's why Legal & General is a cornerstone for income-focused investors. Next up is Vodafone, a global telecoms leader. They connect millions across Europe and Africa, powering calls, texts, and internet access. Beyond mobile phones, Vodafone's enterprise division serves businesses with cloud, cybersecurity, and IoT solutions. Their African operations, through Vodacom and Safaricom, tap into fast-growing markets. This mix of mature European business and African growth offers both stability and potential. Vodafone has long been a dividend favourite, thanks to predictable cash flows from monthly customer bills. Heavy infrastructure investment pays off with reliable revenue. That's why income investors keep coming back. Why focus on Legal & General and Vodafone in 2025? Their dividend yields are among the highest in the FTSE 100. Legal & General's yield often sits around 8–9%, well above average, offering substantial income. In a low-interest world, that's hard to ignore. Vodafone's yield has soared into double digits, partly due to a falling share price as it restructures and pays down debt. High yields are tempting. but can also signal risk. With inflation squeezing households, regular high-yield income is more attractive than ever. Both companies' management teams have publicly committed to maintaining these payouts. That commitment, combined with high yields, puts them in the spotlight for income-seeking investors. But remember, high yield can mean higher risk. Let's look at what you need to watch out for. High dividend yields aren't always a free lunch. Sometimes a yield looks high because the share price has dropped, often a warning sign. This is called a dividend trap. The company may cut or cancel the dividend, leaving you with losses. The key is sustainability. Dividends come from profits or cash flow. Check the dividend cover. How many times profits cover the dividend? A cover of 2+ is healthy. Close to 1 is risky. Vodafone's big risk is debt. High borrowing costs can threaten dividends if profits fall or interest rates rise. Legal & General faces market risks. A stock market crash could hit their fee income and investment returns. Even diversified giants aren't immune to downturns. Always look beyond the headline yield. Assess the company's financial health, debt, and ability to keep paying. Don't chase yield blindly. Understand the risks. Smart investing means balancing income with safety. Don't just chase the highest yield, dig deeper. Check if the company's revenues and profits are growing. Look for a strong brand, unique technology, or market dominance. These economic moats protect profits and dividends. Assess management's strategy. Are they investing for the future or just treading water? Compare the share price to earnings, PE ratio, to judge value. A low PE can mean a bargain or a warning sign. Balance yield with business quality for smarter investing. No company operates in isolation. The wider economy, inflation, and interest rates all impact FTSE 100 firms. Economic growth supports profits. Downturns make things tougher. High inflation raises costs, while higher interest rates can hurt indebted companies like Vodafone, but help financial firms like Legal & General. Politics matter too. Tax, regulation, and government policy can change the game. Vodafone faces telecom regulations. Legal & General is affected by pension and financial rules. Global events, trade disputes, slowdowns, or geopolitical tensions can disrupt business. Vodafone's fortunes are tied to Europe and Africa as much as the UK. Stay alert to the bigger picture. Informed investors watch both local and global trends. So, are high-yield stocks like Legal & General and Vodafone worth it in 2025? Both offer attractive income, but come with different risks. Legal & General is a diversified, reliable payer. Vodafone's high yield reflects both opportunity and uncertainty. Dividends are just one piece of the puzzle. Look for healthy, well-managed businesses. Diversify your investments to spread risk. Your decision depends on your goals, time horizon, and risk tolerance. Use this as a starting point for your own research. Read company reports, check analyst opinions, and consider professional advice. The best investment is being informed. Good luck and happy investing!